let's get on board Nilesh Shetty, who's the portfolio manager of Quantum Advisors, joining in now. Hi, Nilesh. Good afternoon to you, and thank you so much for joining us.
Thank you so
Nilesh,
much.
Nilesh, amid a market like this, it's been a quiet day today. I mean, we have seen the market run up, and then it's a quiet day, coming on the back of the sentiment that of an escalating tension between India and Pakistan. But the pocket that's doing really well are the defense counters. Needless to say why, but all these counters. If you look at HAL, Mazda Dogs, BEL, or Bharat Dynamics, all these counters have actually run up quite a bit. Even in the market drawdown, you can see likes of Bharat Dynamics trading upwards of 50 odd percent. Even Mazda Dogs was doing very well for itself. So do you see that there is still more steam left in these defense counters? Now they are running up on the back of a news flow coming in, but otherwise also, is the defense pack still have a lot of steam left?
Well, unfortunately, we think it is very, very expensively valued. I think their valuations are above consumer staple companies. I mean, for a business where there is only one buyer, which is the government of India, who is perpetually cash constrained, and their budget grows at a certain rate in terms of in line with normal GDP, and the kind of margins that these companies report being state-owned, it's difficult for us to imagine those margins can sustain. So again, it's a bull run theme where in a bull run, people are attributing more value than they should. But at least in our mind, these are not sustainable, these valuations. And at some point, these companies will disappoint if you're a shareholder.
All right. Hi, Nilesh. Good afternoon. This is Shrishti also joining in. Nilesh, financials is the consensus call coming in the market participants. When we look at that, so the liquidity concern has been addressed very well, and the RBI has come at the forefront. But there is a clear differentiation between the PSU and the private banking names. The PSU banks have been lagging way behind some of the major private names like ICICI, HDFC Bank trading at all-time high levels. Help us understand, how do you see this differentiation, and do you believe this trend is here to stay?
Yeah, I mean, it was actually the reverse for the last 3 years. It was the public sector banks that were doing really well, and it was the private sector banks that were lagging quite dramatically. And if you look at valuation bands for private sector banks, they are trading at a sort of significant discount to their long-term medians. But given the quality, that discount should not last. I think they should move materially higher. So at least our portfolio is heavily tilted towards private sector banks. We actually own about 5 large private sector banks in the portfolio. We just own one public sector banks. And of course, they always trade at a discount for a reason because of the quality of book the public sector banks run, because of the high NPAs that they constantly run. So that is not a surprise that they underperform. But what was surprising was the outperformance that happened over the last 3 years in public sector bank space, which we don't think is sustainable. I think it'll revert back to what we've seen over the last 20 years, where private sector banks do a lot well compared to public sector banks.
All right, but Nilesh, when it comes to technology, just wanted to have your take on this, because the street is actually quite divided which side to go, because some are liking this space, some are definitely not liking this space given the uncertainty, and some of the managements are also highlighting the same. Help us understand your view on technology and what makes you constructive at this point in time, if at all.
Yeah, I mean, the bigger risk before the Trump election was this AI and what it means for IT services companies, and does their pricing power erode, which again is genuine. And we are still trying to evolve our sort of thoughts on that. Traditionally, Indian IT services have sort of captured a bit more market in every technology disruption. And we think that may again happen. In what form or shape they address that, we'll have to wait and see. But the bigger near-term risk is, of course, the recession in the US, which may get triggered if the current tariff policies continue in the US, which again defers discretionary spend for IT services companies, which may prolong the revenue slump that they've faced in the near term. But again, when you look at valuations, they are a lot more comfortable relative to the rest of the market. So if you're a long-term allocator, perhaps now is a better time to allocate to this space. But you may need to be patient. You may have to wait for at least 12 to 18 months for that catalyst to play out, where revenues come back. So we do have a fairly significant allocation to IT services companies. So if you look at this year's, I mean, with the way the share prices have panned out this year, they have corrected about 25 to 30%. And we think there's significant value there, but you need to be patient there as an investor.
Right. Nilesh, also talk to us about the Indo-Pak because of the news that that is coming in on the Trump tariff of a relief coming in on the Indo-Pak. Tell us where do you see the Indo-Pak and the auto anks? Would you be now positive on the auto sector or the auto ank now that there is some bit of a relief coming in on the tariff front?
Yeah, I mean, we've at least the way the portfolio was structured for us, we have exposure primarily to domestic names, not big or companies that are exposed to the US. We've never had much exposure there. So where we think, I mean, the tariff issue is immaterial to them. What is the bigger issue is the slowdown in the Indian automobile sales, which may dent near-term numbers for most of these companies. And last year they had a phenomenal run. Most of these companies went up quite materially. And on that base, valuations are not comfortable at all. So if the near-term numbers don't pick up, we think they could have a tough year this year in terms of share price performance.
All right, but within the domestic plays, Nilesh, help us understand that which sectors are you liking at this point in time, barring financials?
Yeah, so we have a large name in a large holding in two-wheelers, which we've been trimming over the last 6 months. We continue to have some allocation to insurance companies where we think valuations are very, very comfortable. We added a consumer durable name, which came off materially for issues within the company. And there is a pharma company we think offers value at a certain valuation.
Right. Nilesh, also tell us about the small and the mid cap space. I mean, there was a lot of froth earlier on. Even after the correction, we are seeing a lot of premium valuation as far as the SMIDs are concerned. Are there any pockets of comfort for you within that space?
So again, the valuation was quite phenomenal, the rally that happened in the small and mid cap space relative to the quality of companies. Now you have to understand the governance standards in India for even large caps are not that great. And when as you go down the ladder in terms of market cap, governance standards deteriorate quite materially. And liquidity also is quite a challenge if you're trying to allocate significant sums, if you're a large portfolio manager like us. So we've been very careful there. At current valuations, despite the correction, they still don't make sense. It's a challenge to find names there with enough liquidity and governance standards for you to allocate the portfolio. So we've actually had very minimal exposure there. We've actually been selling out of the names that we had over the last couple of years.
All right, but Nilesh, any view on Reliance Industries as well as the sectors that Reliance Industry has? I know that there are a lot of sectors that come at play, but I'm sure that you must have tracked the earnings and any specific key takeaway, because there are announcements on the new energy business, and that is also one of the key triggers that could bode well for the company. But sectorally, how do you see the picture shaping up?
Yeah, so Reliance has never been a portfolio stock for us. So we don't track that company that closely. So I don't have a specific view on the company.
Totally take your point. But Nilesh, the other theme that is very much domestically oriented is the power space. The generation numbers seem to be holding out well, and the valuations also doesn't seem to be that expensive. What's your take on the power space overall?
Yeah, we think the valuations are very expensive actually. You have to understand most of these companies run on regulated return. They generate about 15% ROE. And given the size of the book of some of these players, especially the public sector ones, they tend to grow between 8 to 10% per annum. For them to trade at 3 times price to book is actually quite surprising, because these same companies 6 years ago were trading at a discount to price to book, and the growth profile was the same then. So we actually think that space is actually quite expensive. At least the names that we had, we sold them about 18 months ago from the portfolio.
All right, Nilesh, thank you so much for taking the time out and joining us today and weighing in on the markets. We will let you go on that note.